Let's get to today's market action with Vital Knowledge founder Adam Crisafulli and Crossmark Global Investments CEO and CIO Bob Dahl. Great to have you both here. Adam, I'm going to kick this off with you because it was another ping pong day for the major averages. We did finish here mixed. It looks like the S&P up fractionally, maybe 56.33 as we shake out here. The NASDAQ higher, but the Dow ever so slightly lower. What are you watching? Is everything just sort of hinging on tariffs and news we get out of the White House come 24 hours from now?
Yes, obviously the tariff details are going to be crucial. But I think over the last several weeks and months, as we've been debating tariffs and as we've seen some tariffs get put in place and others get rescinded, the economy is already responding to it. And we saw that today in some of the data, specifically manufacturing ISM, where you definitely are noticing a pullback in growth. You're seeing a firming of inflation. And so, I think while we should be focused on tariffs and tomorrow will be very important, the economy is already responding to it. And I think that's kind of the real disconnect. In the immediate term, it could very well be the case that tomorrow afternoon is a relief for about 24 to 48 hours. Then the focus will shift immediately back to the economy. And then, we're just a week and a half away from the start of earnings season. And it's likely companies are going to sound a little bit more cautious than they did a few months ago on the January Q4 call. So, I think there's two important themes occurring in the market right now.
All right. Want to get your thoughts on this, Bob, especially as we've seen Treasury yields continue to move lower. We've had a big rally in the bond market in recent days, in recent weeks. You had the Fed's Tom Barkin saying on CNBC yesterday and then making further comments this morning that he sees the bond market as pricing in a rising risk of recession after basically hinting at a rising risk of stagflation in his comments on CNBC yesterday. How do you see what's happening there, and how much are equities poised to take their cue from what we're seeing in treasuries?
Well, I think the liquidity bazooka, as we've called it, has helped push rates down. But I firmly agree with Adam. There are two things going on here. One is we are at maximum uncertainty. Hopefully tomorrow afternoon, there's a little less uncertainty. That's good news. But the problem is the uncertainties cause people to pull their horns back in. That's part of why bond yields have moved down and why equities have moved down and why people are concerned that earnings risk is in front of us. And therefore, that's the other shoe that's going to drop. So let's hope we get less uncertainty after 24 hours from now so that we can pit that against this inevitably slowing economy.
Speaking of uncertainty, Adam, you've got three tariff scenarios. Your base case is 15 to 20% on nearly all imports, and then there's a slightly better and then a worse. But to what degree are you pricing in escalations after this announcement? And do you think the market is?
Yeah, I think a lot will come down to the details. So are they all going to be implemented immediately? The White House today suggested that you will see immediate implementation. Is there a period of negotiation? If Trump sounds very open to holding negotiations in the coming weeks and months, perhaps you see other countries withhold their immediate retaliatory actions. But definitely retaliation is going to be, a huge risk to all this. So I do think in the immediate term, a lot of the press recently, the preview articles have been quite negative. And so you might see a brief relief. But, the tariff agenda that's being pursued is very aggressive. And at the least, you're going to see a near and medium term hit to the economy, downside on growth and then upside on inflation. And that's going to be a real risk for equities over the coming months and quarters.
And then, Bob, in the longer term, investors seem to perhaps be assuming that demand in the U.S. remains strong post-tariff, but it's unclear to me how many manufacturers are going to be willing to make a decades-long manufacturing commitment in the U.S. if the U.S. consumer weakens. Might they decide to just kind of wait out the Trump years and see if the next president has a change of heart?
Hopefully it doesn't last that long. The consumer is definitely pulling in their horns already. You see that in the sentiment numbers and the spending numbers and the jobs numbers. So we've got to get past this period. Look, the hope is that we're taking the pain now, tariffs, and the gain, deregulation and tax cuts, are next down the road. I wish it were that simple, but that's what the administration seems to be pinning their hopes on.